Welcome to the Real Estate Library, and today we're going to talk about what to avoid during the closing process. So if you're in escrow to buy a home, there's a couple of things that you want to make sure that you don't do. The first would be obviously avoid changing jobs. At least talk to your mortgage broker about it if you have a good opportunity career-wise that you're considering making. Doesn't mean that you shouldn't take the job, but just realize that changing jobs can impact and will impact your ability to buy a home. And if you're changing careers from one industry to another, it may be 2 years before you're able to qualify for a mortgage again. So if you can stick at that job a little longer, purchase the house and then transfer jobs, that's something that you can consider. But you just want to talk to your mortgage broker, because sometimes if you're staying in the same industry but you're changing companies, that's something that the mortgage company might be okay with. So don't make any job changes without talking to the mortgage broker. The second would be to avoid switching banking institutions during the escrow period, and even a good 6 months prior. You want to try not to change banks. And that's because the lender has requirements about what's called seasoning. They want to see that the money's been in the account for a period of time. Every lender has a different requirement for seasoning, so again, it's a good idea to start working with a mortgage broker well ahead of time of buying a home, so you can kind of have a strategy and a game plan for all of these components. But the lender in general, that's the purpose of them having the seasoning requirement, is it helps to avoid loan fraud, wire transfer fraud, people depositing cash and then using it to buy real estate immediately, things like that. So don't change banks, don't change jobs, and then avoid paying off existing accounts unless your lender requests it. So sometimes what can happen is you can say, oh great, I got this birthday money from my grandma, let me really quick pay off this $1,500 Nordstrom's credit card. And then it creates a problem in your home loan that you weren't expecting. And that is because the lender looks at what's called a DTI, a debt to income ratio. And that is the ratio of all of your existing debt, so your student loans, mortgage payment, or potential new mortgage payment, car payment, credit cards, and then your gross income. And they compare those two and they get a ratio or percentage. No lender will give you more than 50% debt to income ratio. Very few lenders will give you above 40%. In general, you want to stay around a 30% debt to income ratio. So you're spending no more than 30% of your gross income every month on outgoing payments for student loans, credit cards, house payment. So if you are in the middle of a transaction and you pay off one of those accounts, that's going to throw off your debt to income ratio, and it's going to cause the mortgage broker to have to recalculate everything. So it's not necessarily a bad thing, but just talk to your mortgage broker before you decide to pay anything off. There might be strategic ways that you can pay off certain accounts in certain amounts that would benefit your credit score more than just paying off one account. So let's say, for example, your credit cards are almost maxed out, all of them. Instead of just paying off one credit card and still having 4 more that are maxed out, you might want to spread that balance out and then use it to pay down all of your credit cards to where it's a lower debt to income ratio. So those are things to think about. If you have any questions about how to buy, sell, or invest in real estate in California, feel free to send me a direct message. Talk to you guys soon.